So at Burrito, we want to give our clients the insights and tools they need to navigate the investment space. So we're going to give you a front row seat to our Brain Trust, where they'll speak about their outlook for 2021. What does it mean for the economy and asset classes? And most importantly, how does this affect your investment portfolio? So come and let us help you build your money IQ.
Welcome to the Burrito Brain Trust Think Tank. As a part of the Burrito's Brain Trust, we like to showcase the in-house talent that we have. And today we'll be talking to the investment strategy and the research team. Welcome, guys.
Thank you, Sam.
I'll allow the guys to introduce themselves, starting on my right.
All right, so I'm Hartner Richards. I'm the Senior Investment Strategist at Burrito, and my objective on a day-to-day to find out opportunities for our clients and our portfolios to generate a set of alpha or returns that create substantial performance for different individuals.
Yeah, Richard Williams, Head of Investment Research and Strategy, and I help Hartner do all of that.
So I'm our Muirhead, Senior Investment Strategy Analyst, and we basically work together, Hartner and I.
So everybody So my name is Simon Johnson. I'm the AVP of Alternative Investments and Structured Finance at Burrito Investments Limited. As a part of my role, I help to manage both the on and off balance sheet portfolios of alternative or non-traditional assets, and I also aid or drive the structured products creation part of the business. Today we'll be talking about the investment outlook. So we're looking at the local investment outlook, and then we take a step back and look at our global outlook. However, the team has developed the three main drivers that they think will shape the investment environment for 2021. Richard, I wanted to start us off with our first theme that speaks to policy and vaccines.
Yes, thank you, Simon. Certainly the course of any form of recovery, both locally and internationally, will be shaped by vaccination policies, practical things such as how do you execute in terms of the distribution to the most vulnerable groups, those on the frontline workers, and how do you clear supply chain backlogs, how do you manufacture additional doses of vaccines, etc. Naturally, that will impinge on how economic activities perform thereafter in terms of the pace at which economies reopen, the pace at which some of the economic lockdown measures are lifted, etc. So that is our view, that whatever recovery we eventually see, whatever shape we see, will be shaped by the approach to vaccination, how successful we are at it. One of the things that we have been looking at really is the risk of the pandemic going much longer than possible. But also one of the risks that we want to introduce now is that the pandemic could possibly be shorter than we currently anticipate. JP Morgan last week, Marko Kalanovich, who is the head of their quantitative research there, he has been remarkably on point thus far in their modeling. What they're saying is that it is a possibility that we could see the end of the pandemic anywhere between 40 to 70 days from now. So of course, it's something that we can think about. The upshot is that we can see a faster recovery in many of the downbeaten assets that we have seen, should such an eventuality occur, because that is not now the consensus view. So that's something that we want to throw into the mix.
Okay, Richardo. The second theme speaks to the dawn of a new normal in asset management. Talk to me about that. As well.
That's a very interesting idea, Simon, because we all know, and this goes back to one of the first think tanks that we had very early out in the pandemic that we had here at Burrito, because we like to keep clients informed. And we spoke about unprecedented monetary and fiscal policies. One of the upshots coming out of that is that bond yields, for instance, are now at their historic lows. And what that has done is it has forced investors to rethink the traditional approach of portfolio allocation, the so-called 60-40 allocation, 60% to bonds, 40% to equities. Now, the role of bonds typically in those portfolios is basically to manage your downside risk. That is, if there's a sell-off in the market, then the bonds would offer you some protection. But with yields so low, and they are poised to continue to be that low. I mean, if I could just mention last week, sub-investment grade yields went under 4% for the longest while. It just shows the kind of search that people are looking at out there for yields. What it means is that the traditional approach of 60-40, or a larger portion of your portfolio going towards bonds or fixed income, we might need to revisit that in this dispensation going forward. And of course, we will have some ideas in this conversation about how we can achieve that.
Okay. You made a point about low yield investments and that bonds are at historic lows. This gives us a good segue into the third theme, which is creativity in a low yield environment. So how do asset managers, how do investors perform in such an environment? And that is your third major theme. Talk to me about that.
Yeah, so Richard gave a really good opening into how yields have been performing in the context of the pandemic. So asset managers have now had to really just reposition themselves, right? And the assets that they're really looking towards right now, particularly, I think the first good one would be alternatives, right? So when we think about alternatives, we're thinking about real estate, for example. We're thinking about private credit, we're thinking about private equity. So as yields have come down significantly, asset managers have to broaden their scope and are now looking within the alternative space. Additionally, as Richardo alluded to a bit, right, asset managers, though bond yields have significantly declined, right, there's still yield out there, right? So the search for yield has been significantly more aggressive, and as a result, we find that many asset managers are really going down the credit spectrum, right? So they're looking for assets, or bonds rather, that have higher yields, but at the same time have higher credit risk. So that is the positioning that we've been seeing as it relates to, just being more creative in terms of, accessing yield in this low yield environment. One additional point that we've really noticed recently is that as stocks have really been producing cash flows, we've seen that dividend yields on a lot of equities have actually gone above what traditional bonds would have been yielding given the low interest rate environment, right? So traditional investors have to be moving away from that 60-40 allocation into alternatives, further down the credit spectrum, as well as into dividend paying stocks that provide additional yield above what bonds are generating at this point.
Right, the eternal search for alpha. We've reached a point where you can get better cash yields in equity than in high yield securities.
Yes.
For some parts of equity.